Welcome back, everyone. My name is Randy Helm. This is the ninth video in this cash management series. In this video, we will cover the critical topic of cash flow analysis. Conducting a thorough cash flow analysis allows you to gain insights into your business's financial health, identify cash flow patterns, and make informed decisions to improve your cash flow management. Now, if you're ready, let's begin. Cash flow analysis involves examining inflows and outflows of cash within your business over a specific period. You gain valuable insights into your business's liquidity, cash position, and financial performance by analyzing your cash flow. Cash flow analysis serves some important purposes. First, it provides an understanding of the sources and uses of cash within your business. It helps you identify where your cash is coming from and how it's being used, and whether it aligns with your business objectives. Second, cash flow analysis helps you identify cash flow patterns and trends. By examining historical data and tracking your cash flow over time, you can identify seasonality, cyclical patterns, or areas where your cash flow may be inconsistent. Let's break down the key components of cash analysis. Operating cash flow. This is a representation of the money that your company's primary operations produce or spend. It presents your cash flow as a result of your income, outgoings, and working capital management. When you consider the normal operations of the business, this is what comes to mind. Examples of this include buying inventory to sell, selling that inventory to your customers, customers paying accounts receivable balance to your firm, paying your employees, paying your utilities and your rent, you paying your accounts payable balance to other firms. There can be a lot of moving parts here, so it pays to focus on this section and understand what's going on. The operating cash flow is usually going to be where most of the critical elements are. Investing cash flow. This captures the cash flow related to your business's investments and assets, such as property, equipment, or marketable securities. It includes cash spent on acquiring assets or cash received from selling assets. Examples of this include buying trucks and cars for your business, selling older trucks that are no longer serving you well, buying a new oven for your restaurant, buying new tanning beds for your salon, investing money in some stocks that are in the S&P 500 or part of the Dow Jones Industrial Average. Where you are in the business cycle determines how much investment activity there is. Investments in your property, plant, and equipment may take up a significant portion of your cash flow if you are a startup business in your first or second year of operation. You shouldn't be concerned as long as you can see the investment's conclusion approaching. You must pace yourself, of course. You cannot allow the number of investments to completely deplete your financial resources. There must be equilibrium. Financing cash flow. This tracks the cash flow resulting from your business's financing activities, such as raising capital through loans, issuing equity, or making loan repayments. It includes cash inflows or outflows related to borrowing or equity transactions. Some examples include taking out a term loan with your bank, borrowing on your line of credit with your bank, receiving money by taking on an additional partner in your business. When you make a monthly payment on your loan, it includes the principal portion, but not the interest portion. That interest portion is covered in the operating cash flow section. If you haven't yet, please consider subscribing to this channel. And if you have found value in the videos, please hit the like button. It really helps out this channel. Thank you. Now back to the program. The cash flow statement is a key tool for conducting cash flow analysis. It summarizes your business's cash inflows and outflows during a specific period, categorizing them into operating, investing, and financing activities. Well, isn't that special? The cash flow statement provides a clear picture of your cash position and helps you evaluate the liquidity of your business. It's essential for understanding the sources and uses of cash and identifying potential areas for improvement. If you want a more detailed review of the cash flow statement, I have a video for you may want to check out. I will put a link in the description below. Cash flow analysis also involves utilizing ratios and metrics to gain further insights into your business's financial health. Let's explore a few commonly used measures. Operating cash flow ratio. This ratio measures the ability of your business's core operations to generate cash. It compares your operating cash flow to your current liabilities. This is the ratio that you want to be high. If high enough, it shows how much more cash was generated than would be needed to pay off the current liabilities. Ratios well below 1.0 could indicate the company is having trouble, although not always the case. The formula is cash from operations divided by current liabilities. Free cash flow. Cash provided by operations minus capital expenditures, which is the money spent on fixed assets. Since fixed asset spend is not shown on the income statement, this figure is a way to tie those together. There are multiple ways to calculate this formula, but here is a common way. Cash flow from operations plus interest expense after taxes minus CapEx. Now here is the main measure, the cash conversion cycle. This metric evaluates the time it takes for your business to convert inventory into sales and then into cash. A shorter cash conversion cycle indicates better cash flow management and efficiency. And the formula is the days of inventory outstanding plus the days sales outstanding minus days payable outstanding. The first part focuses on how long it takes to sell the inventory. The second part focuses on how long it takes to collect cash from the sales, to turn the accounts receivable into cash. The third part focuses on how quickly you pay your suppliers. So let's summarize the key points we've covered in cash flow analysis. Cash flow analysis provides insights into your business's financial health, sources, and uses of cash. It helps identify cash flow patterns and trends, enabling informed decision-making. A cash flow statement is valuable for analyzing your cash inflows and outflows. Ratios and metrics provide further insight into your business's cash flow performance. By conducting a thorough cash flow analysis and utilizing ratios and metrics, you can understand your cash flow dynamics and make informed decisions to improve your cash flow management. Cash flow analysis is a critical aspect of financial management in your business. By understanding your cash flow patterns and utilizing the insights gained, you can optimize your cash flow, maintain financial stability, and drive success for your business. In the next video, we're going to cover different tech tools to help you manage cash better. Until then, have a good day.